Now that we've estimated our production for January and February, we can project our direct material, direct labor, and manufacturing overhead budgets. The information we'll need to focus on relates there to direct materials. We need 2 feet of lumber at $2 per foot. Now it is $4 per unit. We began with 10,000 feet of wood, and we want to increase that by 10% each month next quarter. Now all of that will need to be factored in to our purchases budget. To calculate purchases, you'll begin with production. You'll multiply by the direct material required per unit. That will give us our total direct material required. We'll add our ending direct material inventory to get the total materials needed. We'll subtract our beginning direct material inventory, and that will give us our purchases in terms of feet. Once we know how many feet we're going to buy, we'll convert that to a dollar amount by multiplying by the direct material cost per foot. And that will give us our direct material purchases in dollars. So notice that we do find out how many feet of lumber we're going to buy and factor in our beginning and ending direct materials, and then we convert it to a dollar amount. Recall that we computed production to be 10,400 units for January. Each unit requires 2 feet of lumber. So we're going to use 20,800 feet of lumber in production. Now remember, we want to end with 10% more than we began with. And we began with 10,000 feet. So we want to end with 11,000 feet. We need 31,800 feet of lumber. We began with 10,000, so we need to buy 21,800 feet. The cost per foot is $2, so direct material purchases are $43,600. In February, we calculated production to be 11,400. We need 2 feet for each one of those that we produce. We will use 22,800 feet in production. We're going to increase inventory of direct material by 10% again. So that would be 11,000 times 110%, or 12,100. We need to have 34,900 feet of lumber available. We began February with 11,000 feet since we ended January with that amount. So we only need to buy 23,900 feet. The cost per foot is $2. Direct material purchases $47,800 for the month of February. Next up is the direct labor budget, which will also be based on production. Remember that each unit produced will take a quarter of an hour at $16 per hour. We'll calculate this for both January and February. We'll take production in units. We'll multiply by the number of direct labor hours required per unit. That will tell us the total direct labor hours required. We multiply by the direct labor rate per hour, and that will tell us our total direct labor cost that is budgeted. In January, we expected to produce 10,400 units. Each unit requires a quarter of an hour of labor, so our total direct labor hours, 2,600. Our pay rate is estimated to be $16 per hour, so labor cost is estimated to be $41,600. For February, 11,400 units will be produced. Each unit requires a quarter of an hour. 2,850 total direct labor hours are expected. The rate is $16 per hour, so the labor cost is $45,600. Our last production cost we'll need to budget for is manufacturing overhead. We'll calculate both the total amount of overhead expected and the cash disbursements expected for manufacturing overhead. We'll prepare this budget for both January and February. We'll start with our variable overhead rate. Because our overhead rate is based on direct labor hours for this company, we'll multiply by total direct labor hours, and that will give us our total variable overhead cost that is expected. We'll add to that our fixed overhead, and that will be our total budgeted manufacturing overhead cost. So recall, variable overhead is $2 per direct labor hour, and fixed overhead is expected to be $15,600 each month, of which $600 is for depreciation expense. All right, focusing on the variable overhead first. The rate is $2 per direct labor hour. We'll multiply by 2,600 hours, and we'll get total variable overhead of $5,200. Now, if this had said $2 per unit, we would multiply by number of units. If it had said $2 per direct labor dollar, we would multiply by total direct labor dollars. Companies will apply overhead based on various activities. The fixed overhead will be added next. Well, let's look at February. $2 per direct labor hour times 2,850 hours from the direct labor budget says total variable overhead will be $5,700 during the month of February. Now turning our focus to fixed overhead, we're given that fixed overhead is expected to be $15,600 each month, and we're told $600 of that is for depreciation. Now recognize that the way that Noah and company came up with the $15,600 is they listed out each of their fixed overhead costs, such as factory rent, factory insurance. We're only told which part is depreciation. While depreciation is an overhead cost, it is not a cash type expense, so that will play in when we go to convert the total overhead to the cash paid for overhead. So we'll add the fixed overhead of $15,600 to get total budgeted overhead cost in January of $20,800. For February, $15,600 plus $5,700 says total budgeted overhead cost is $21,300 for the month. Now we need to focus on how much of this will be a cash type expense. So what we need to do is subtract the depreciation expense that was already included in the overhead. That amount was given to be $600, so while $20,800 of overhead cost will be incurred, the cash paid for that will only be $20,200. In February, $21,300 will be incurred, minus the $600 of depreciation. The cash paid for overhead costs will be $20,700. Now that we've projected the direct material, direct labor, and manufacturing overhead costs, we can value our ending finished goods inventory. So first we'll compute the production cost per unit. And remember, you need to know whether we'll be using variable costing or absorption costing. In this problem, the company uses absorption costing, so you will need to remember the basics of both of those methods. Absorption costing means that direct material, direct labor, variable overhead, and fixed overhead will be assigned to inventory. So that will be our total production cost per unit. If the company had used variable costing, of course, fixed overhead would not be included in the production cost per unit. Let me remind you that materials is 2 feet of lumber at $2 a foot or $4 a unit. Labor, 0.25 hours at 16 per hour or $4 a unit. And variable overhead, $2 per direct labor hour. The fixed overhead is $15,600 each month. So direct material, $4 per unit. Direct labor, $4 per unit. Variable overhead, 50 cents per unit. Fixed overhead, we'll have to compute that. We know that we will incur $15,600 in overhead cost, and we are going to produce 10,400 units. So that gives us $1.50 per unit. Add all of those up and you get $10 per unit. $10 times the 2,400 units that we're going to have at the end of the period. You'll have to go back and look at the production budget to see that we projected we will end January with 2,400 units. This budget is for the month of January. Alright, so our ending finished goods inventory will be valued at $24,000, and we'll use this $10 to compute ending inventory and cost of goods sold.